Welcome, everybody. Happy to be here as always. It's Friday. Looking forward to our Rebel Income Insights live stream. Excited to see so many people here. As we get going, just a couple of things. Really simple. If you like some of the content that we're going to be talking about and you have some comments, please feel free to use the chat to post comments or questions. I will be paying attention to that and trying to fold those into the conversation today. As always, and your participation certainly helps to make a big difference in the overall content that we cover. Also, feel free to like the live stream. That's good for the YouTube algorithm. You can also use the emoticons in the chat area to react to specific portions if you like them. You can do everything from hearts to laughs and so on. So feel free to use those as much as you would like. And then again, feel free to comment and ask questions. All right. Let's go ahead and get straight to it. We are, as always, uh, looking at Expiration Friday. It is the first Friday of November, so we'll be looking at all of the current open positions that I've been tracking and that I've been writing about in the Rebel Income blog. And we'll probably have some time to look at some of the things that you may be looking at and may have some questions as well. So keep those in mind. And as we get through the things that we normally talk about, feel free to provide your own comments, and let's make this as interactive and as engaging as possible. Okay. Well, with that in mind, there are a couple of trades that are on deck for expiration today. The first is a put sale that we placed just before Halloween on Delta Airlines. We'll see how that one is shaking out. Some headlines that I saw yesterday for Delta weren't especially encouraging. So here's the chart. We do see the stock is retracing just a little bit back from those pre-Halloween lows, which were up around in this area. So the stock's around 56.50 right now. And for context on this trade, I sold the $58 strike price. Oops. There we go. I can use my tools. Okay. I sold the $58 strike price, bringing in $1.50 for 9 days and achieving about almost a 2.6% premium on the put sale. Now that's really attractive, and part of the reason for that trade, besides the normal elements of Delta's quality and value proposition, was also the fact that implied volatility for the stock has been a little bit higher than normal, as the stock has shown some volatility, as we can see really through most of the past couple of months. This is kind of a little bit higher than normal volatility from one day to the next, and that's created that creates an increase in implied volatility for the option that inflates the value of its options. Now, the stock is actually even dropping right now as we speak. It's down about 25 cents from where we started the conversation today. So it does look like I'm going to be assigned the stock at 58. Now, this is one of the things we have to keep in mind, and is a core element of the Rebel Income system to keep in mind, is that whenever you're selling a put option, you're giving somebody else the right to force you to buy the stock at the strike price that you're selling. That can happen anytime leading up to the expiration date. For most American options, assignment doesn't happen until the expiration date. But this is something that that you have to keep in mind. So um, one of the things that I try to make sure to emphasize is always when I send out my trade alerts that this is a stock if I'm willing to own at the price the strike price I'm selling. So in the case of Delta, I made sure to include a statement that I like the stock at 58, and if it's below that price at expiration, then I'm going to take the I'm going to go ahead and take the assignment. Now that means I'm going to be about $1.50 in the hole, assuming the stock closes around the price it's at right now. We'll see. It's recovering just a bit all of a sudden, which is kind of interesting. But we'll see if that kind of we'll see where it lands for the day. It would actually surprise me if we finish above 58. So this is the strike. This is where I sold it. Um, my method is to simply take the assignment and wait for the stock to give me a new opportunity to keep selling covered calls, keep the income generation going. This is a stock it's already recently declared a dividend right here in the middle of October, so didn't qualify for this at all. It was paid out yesterday, in fact. So there's not going to be a another dividend payment for probably about 3 months. I may or may not end up holding the stock that long. I honestly don't know. For some people that like to use that like to sell put options, the preference is not necessarily to take the assignment. And so if the stock is at a position where you're going to be taking an assignment in a lot of cases, a lot of traders will look to unwind the trade and eliminate the potential obligation. That means buying the stock back or buying the option back and closing the trade before expiration. And expiration literally is the close of business today. So there is still an opportunity to close this out if we wanted. Now, keep in mind on this one, I brought in $1.50 in premium. So this is the number to keep in mind in terms of thinking about whether or not closing the trade and avoiding the assignment makes sense. So let me just write down here. Here's $1.50. This is the premium. So I'm going to put a plus sign here. And if I wanted to buy this back, the 58 contract is right here. And since we're working, we have to buy to close. You're always selling to open with put sales. So since we have to buy to close, this would mean right now I'd have to pay $1.70. That's the asking price. Now I could try to massage that. It looks like the last trade was $1.41. That might be interesting. If I could repeat that, I would still come out with a positive credit. But let's just go ahead and assume that I just take the asking price because I just want to make sure. I don't want to wait for the trade to come to me. I don't want to wait for the market. I just want to move on. I pay the $1.70. Now the obligation is removed and I've lost 20 cents per share. Relatively speaking, to a lot of the assignments that I've taken in the last few weeks, the opportunity to close the obligation with a very minimal loss like this is kind of rare. So this is really interesting. This is a function in part of the elevated premium I was able to bring in when I placed this trade. So this is interesting. Let's look at the contract details. There's certainly enough open interest here. There we go. A little bit of volume, not a ton, but there's certainly enough open interest that if you didn't want to buy it back, you would have an opportunity to. Excuse me. So that's interesting. If anybody else is in this trade as well, or maybe you've taken a different tack with it, feel free to put that in the comments. I need to take a drink really quick. Excuse me. Apologize. I didn't want you to hear me clearing my throat. Okay. Why not roll? That is a really good question, and that's one of the things that buying the option back right now would provide. You've got a minimal loss, right? And so you could, literally speaking, buy this back, take a very small loss, and then consider whether or not to, if you wanted to continue to work with Delta. Implied volatility is still a little bit high. And with the stock right around 57 now, that does some interesting things, doesn't it? Here's the $58, $57 strike price for 1 week. 51 on the bid there. 57 for 2 weeks, $1.70. 56 is $1.20. This one, excuse me. Sorry, I was looking at the wrong expirations. This is the 7-day contract. So this is interesting. Here's a 55. You bring in 90 cents on this one. This would be significantly more conservative than either the 58 or even looking at the stock at around 57. This isn't a recommendation to buy or sell. I'm just trying to answer the logical question that Gib asked, which is, consider the different alternatives here, and rolling is an option. Considering the very, very minimal loss you could take. In fact, I know some of the people that have been a part of our group that would be screaming at me right now, "Why aren't you doing this?" But take a look here. And the reason I came back to the chart is to point out the low end of this range is maybe a little bit below 56, but not much. So I'm just going to call that support 56. Now that doesn't hurt. That doesn't scare me as far as the contract that I've got. So I still am okay with taking the assignment because if it does bounce, I'll have an opportunity. I'll own the shares. I'll have an opportunity to start working with covered calls, which I like very much. But if you didn't want to take the assignment at 58 because of the fact that it's below that point, and you wanted to try to provide yourself a little bit more buffer, you wanted to make that a little bit more conservative, going here at 90 cents at 55 for 7 days is really interesting. Let's think about the idea here of trading frequency and compounding, the increased compounding effect that this gives you. Literally speaking, if I were to buy back the $58 put right now, I would lose 20 cents. That would mean that my net credit, if I were to sell the 55 contract for next week, I'd have to offset the 90 cents here that's available. So my net credit would be 70 cents. Let's divide that by 55, and that's 1.27% for 1 week. Now that doesn't sound like a whole lot, but remember, we're talking about a 1-week trade. And in simplified terms, if you can do this every week, if you can produce 1.27% every single week for an entire year, that's 52 trades. You're talking about an annualized return of over 66%. Now, again, this is very simplified math. The truth is, you're not always going to have the opportunity to do this every week. Implied volatility on the stocks that you're working with, including Delta, are not always going to be this high. Delta is not always this high, okay, to be clear. This is just one of the things that's been characteristic of the stock lately. Um, but this is really interesting. And this is why when you see opportunities like this, sometimes it makes sense. Again, like I can't, I'm shying away from actually saying you got to place this trade. But this is the kind of thing when you see this kind of opportunity, it's really hard not to ask why don't you do it? Because if we're thinking in terms of the low hanging fruit of the market, this is it. These are the opportunities that the market provides when you're working the sell side of the market, and that the majority of traders just don't even think about or pay attention to. If maybe you didn't place the delta trade with me when I did, you may be thinking, well, why not use this one? Maybe the 55. Maybe even if you wanted to be more conservative, why not the 54? Why not go for 1% for 7 days? A little over that, right? Again, none of these are bad choices. These are just different choices. They're just alternatives. So there's a lot of different ways that you can think about what you can do to generate practical income with put selling, depending on what your preference is and what your method may be. The beauty, too, of something like this is that with time decay, with expiration so close, the time decay element is really starting to work for you. And so there's a really good chance if the stock stabilizes at all. Again, let's go back to the chart here. We've got really strong support right in this $56 range. So if the stock shows any kind of stabilization at all in this range, there's really an excellent chance in just the next 7 days that there will be an opportunity to leverage the time decay element, possibly shorten the trade duration from 7 days to maybe 3 or 4. I don't know. So there's a lot of different ways you can think about this. Yeah, here's 2 weeks out. Look at 54 with a 94-cent premium. That's really interesting. For 14 days. 0.94 divided by 54, that's 1.74%. For a 2-week trade, we multiply that by 26. That's how many trades you'd be able to place every 2 weeks. Now we're lower than what we were just talking about with the weeklies, but you're still looking at 45%. So again, not a bad choice. It's just a different one. And if you're trying to think about, when is the next earnings report, you've got some time to work with, because we're not expecting the next earnings report until sometime in the second week of January. So that helps. Gib, I appreciate that question. Thank you for helping me make sure that we go through and we consider those other choices. Any other thoughts on Delta? Anybody else that's been working with this stock and not wants to offer your own take? Otherwise, we can move on. All right. The other trade that we do have for expiration set up today is a covered call on Schlumberger. SLB Limited, excuse me. I've been working with SLB for so long that I tend to call it by its older name. Yeah, maybe the controllers will be back. That is one of the things that is contributing to the volatility in the stock right now. And some of the latest news is, that service is being cut back because of the shutdown, right? So that's having a real impact. It's going to have a real impact on Delta's numbers in the next few quarters, and that could put some additional pressure on the stock's price. All the same, the overall core fundamentals for Delta are really, really solid. And if the shutdown ends sooner than later, um, some people might say that's an oxymoron right now. But the sooner that the shutdown ends, the lower the overall impact would be expected to be. So again, that's just something that's going to have to play itself out. And it may be, uh, Gib, thank you for that comment too, because that brings up another element here. I placed this trade in spite of some of those pressures, right? And if you chose not to, because maybe you think that adds an element of risk that you didn't want to have to deal with right now, that's also perfectly fair. Okay, let's talk about SLB then. Again, this is a stock I've used quite a bit. And that's I'd really tend to just call it by its former name, which is Schlumberger. But on this one, this is a stock that I was assigned earlier in August at $35, and this has been a really functional position. This is SLB is a really good example of the reason that I don't mind taking assignments, even though sometimes that means that I have to ride stocks out through a very long downward trend. Schlumberger, in this case, has produced a number of productive income generating trades. Let me just scroll up. Here's a covered call at the end of August that expired. So there's one. Here's another one. There's two. And this is covered call number 3. Actually, that's not even true. Sorry. Here's one. Here's two. Sorry. Here's 3. And this is cover call number 4. So this has been very productive and allowed me to generate a significant amount of income on this stock at an increasing price. So the first 3 were all at 36. This one's at 37 because the stock had been showing some momentum. So let's see where the stock is now. See if it's going to expire again, and I'm going to hang on to the stock. All right. So it's flat for the day. We are seeing a little, after a big surge in the early part of October, that started to moderate a little bit, but it's still been climbing, just not really fast. So it's at 36.40 right now. My assignment price, my purchase price is down here at 35. So I am positive on this one by almost $1.50, which is nice. But it does look like my covered call, which is at 37, is going to expire worthless. Okay. Now this is an interesting technical setup right now. because with the way that the stock rallied here very, very quickly, and it started to taper just a little bit. Barry's at 36 expiring, so looks like, Barry, you're going to get called out, which is nice. That's cool, right? We like getting called out because that frees up cash and should hopefully give you a net positive result. But with it starting to with the momentum starting to moderate. I'm not going to say that it's tailing off, but it is moderating just a bit. What do you think? Is the risk of a drawdown starting to increase? What are the chances that the stock is going to pull back? I want to get some of your thoughts here. Okay, Barry, we'll take a look at CTRA. I think I'm going to assume it's CTRA unless you do actually mean CRTA. We'll take a look at that one in just a minute. But the interesting thing about this big momentum here, we've started to create some distance. Okay, yeah, that's a typo. No problem. We started to create some distance here, and so there is a chance that we may see the stock. We may see the stock's momentum fade even more. It could possibly decline, but the really interesting part of this right now is this 200-day moving average, which is now starting to flatten. And the stock is above the 200-day moving average, which means that this level, which is a little bit above 36, should start to act as current support. We also have the rising 200-day moving average, which is right around 35. So that's right around my assignment price, which also could act as secondary support, providing some additional strength. The truth is that even if we do get a little bit of a pullback on this, what we are increasingly likely to see, let's suppose that it does start to pull back here. What we're increasingly likely to see is just a simple retracement and bounce back up above. This is starting to look like a very, very possible trend reversal. So we'll see. Gib has been testing this high since April. Okay. I hope that means that that's the number of productive trades that you've had, because or that it's led to several productive trades up in this range. Because yeah, we have been here before, and it hasn't been able to exceed it. That's why I think that the push above the 200-day moving average is really a positive, and the bend of the 20-day moving average, starting to see a different kind of convergence of signals. Gib, I wish. Sometimes that happens. Starting to see a different kind of convergence of signals. And when you see these kinds of convergences, again, you start to see the probabilities for a technical break in a positive fashion usually tend to increase. And by positive, I simply, in this case, since I'm already in Schlumberger, I mean a break to the upside. Since I'm obviously bullish on the stock if I'm holding shares. So okay, that would really be relative to the trade that you were trying to work. So okay. So we'll see on this one, but yeah, it does look like, unless we see a really big push, I don't know, just in the little bit of time we've been talking, look at this, it's made up about $1 in price action. Maybe I get called out today. I don't know. All of a sudden, I don't really feel like I can dismiss that possibility. If I am, that's a pretty nice result with all of the premium that I brought in, plus the $2 difference between 35 and 37 as a capital gain. But this is a really good example of of why I think that the income generation and taking the sell side of this is so effective. Let me highlight these premiums again. Let's see, where's the initial put sale? Here we go. So 65, that was the first premium I brought in. And then after that, $67, then $81, 70 cents, and then $78. So 67 plus 65 plus 81, oops, 0.81 plus 0.7, that's 70, plus 0.78. So premiums that I've been able to bring in this one are $3.61 per share. I also brought in a dividend here of 28.5 cents. Sorry. So it was 361 plus 0.285. There we go. So 389. And if I am called out, then that'll be an additional $2. When I divide that by the $35 price I was assigned in August, talking about an almost 17% result for a trade that's gone a little over 2 months. I guess 3 months, excuse me. It's gone 3 months. So 17% for 3 months of time. I don't feel bad about that. In fact, that's something that's a really nice result. And it's a really good example of the reason that I think that put selling is so useful. It's also, kind of to what Gib was talking about in terms of testing highs. It's also a reason that these consolidation periods become so useful, because you may take an assignment during these, but the longer the longer the consolidation period lasts, the more opportunities you usually have to generate income with covered calls, and sometimes with multiple put sales. If you're working around the low end of the consolidation range, you may have multiple put selling opportunities to work with as well. So, okay. So that is SLB Limited. Next week, we do have this week's put selling trade that I placed on FCX. Starting to look back at the miners a little bit. And on this one, again, I'm really interested to see if some of you were working with the same trade. Selling the $39 strike price in this case, and bringing in 67 cents per share. for about a 1.7% result for this is another 9-day trade. I really like it when I can really shorten the time period, time duration of the trade. I'm usually in the neighborhood of 17 to 18 days. But when we can shorten them down to a week or so, that just gives us an opportunity to accelerate the compounding effect, which is really which is something I really like. But let's take a look at where this is now. Remember, I sold the $39 strike. Here's FCX. Again, if you're also working with this, love to see what your numbers are like. Now, this stock has been volatile this week, dropping down below the 200-day moving average, which is a little bit above 40. It came all the way down to near 38 yesterday, and is showing some good positive momentum today, even though it is below the point where it started. It is at about 39.38. So as of now, the stock is still above my strike price, but we're very much in kind of a limbo area right now, aren't we? Right below the 200-day moving average. Looks like pretty strong support, even based on this pivot low, a little bit above $38. So, what is going to happen in the next week? That is an open question. Excuse me just a moment. Okay. Can everybody hear me okay? Okay, perfect. Thank you, Barry. Just wanted to make sure I turned the mic back on and it was actually working. So, all right. So, right now, again, I've only been in this trade for a couple of days, and I brought in 67 cents. But with that limbo zone in mind, I want to think about and talk about the possibility of managing this trade a little bit more actively. Now, everybody knows my method. I'm going to let this play out and see where it lands. That doesn't necessarily mean that it has to be the way that you do it. So here is 39. And I brought in 67 cents on this. Here's the $39 strike. Here's the asking price of 92 cents. So it's already up about 25 cents. If I wanted to buy this back, I'd take about a 25-cent loss on this. And that's just in a couple of days. If you're afraid of more downside on this one, and you don't necessarily want to deal with that additional downside, I mean, if the stock doesn't hold here in the $38 range, this next level looks like is in the $35 range. Next really likely support. Well, that looks a little scary. It's about $3. A little under 10%. below the stock's current, below that support level, and a little over $4 away from the stock's current price right now. Well, the stock is above 39 right now, and I do like this support in the $38 range. So for me, this is going to be a matter of being patient and letting the stock's time decay, or the options time decay, excuse me, start to work for me a little bit, and see what happens in the next few days. The weekend should be useful if this current momentum generally holds, and we start the week in the 39.50 range. That should be interesting. And so we'll be in. It's going to be interesting to check back on this next Friday and see where it lands. As with every other trade, that I place, I'm not afraid of taking the assignment here, even if it does, even if the downside does accelerate a little bit. The value proposition is really, really attractive. It's about 20% above the stock's current price right now, and at the moment, I don't have anything in the mining sector. So this is a way to try to take advantage of that sector a little bit, which can be kind of defensive. I like to think about mining stocks as kind of a proxy for precious metals, as opposed to just buying gold or silver outright. These stocks often provide another way to think about that. And so in some ways, these can be a little bit of a defensively positioned uh, kind of a trade, even though these stocks can be volatile. Let's face it, precious metals prices can be volatile. So it doesn't mean you're not going to see price movement, but it does mean that these kind of can provide a counterbalance against inflationary conditions, and some situations that can otherwise be a little bit bearish for the broader market. Sometimes, in those cases, these stocks become useful hedges, as it were. Okay, all right, that's FCX. Again, if you're in this one as well, don't hesitate to give us your numbers. Okay. So that is next week. Beyond that, everything else that is on deck is set up for the third week in November. That includes the put sale on Eastman Chemical. This is another play in the material sector. I already have a couple of stocks in this one that are in my portfolio, and so this is another conservative position on a stock that is even more deeply discounted than FCX. I sold the $55 strike price and brought in a little under 2%. This is a 30-day trade. So been in this one for a couple of weeks. Let's go ahead and take a look. Okay. And 55 is the strike price that I sold here, with the stock showing some good momentum above that price. And 55 is below these two pivot low points, so we should have very solid support. The stock is in a long-term downward trend dating back to, what is this, September of last year. And considering the distance between, let me change my colors here, considering the distance between the 200-day moving average There's the 200, the blue line, and the green 20-day moving average. That means 60 to 76. We're a ways away from calling for a trend reversal here. This is a stock that even if it does begin to recover, it's got a lot of room to make up before it can really set up any kind of uh, legitimate patterns that are going to point technically to a trend reversal. But it does look like it is starting to consolidate a little bit at the low end of this range. We've got really solid support in that $56 range, and looks like resistance around 64. So there's about an $8 range here that we're working with on this stock for consolidation purposes. Again, when we're talking about opportunities for very near-term trades with put sales, even some swing trades if you wanted to go that way, this is an interesting consolidation range to play with. Stock has been dropping back the last couple of days, but is still above that $60 mark. So with with a little over $5 difference between the stock's current price and the put sale, the contract that I sold, this really does bring up questions about the opportunity to roll, manage the trade more actively. Just for reference here, this is the premium that I brought in on the put sale is $1.05. And this is a stock that uses monthly options. There's no weeklies here. That does complicate the question. Also, you have to you also have to contend with the fact that there's $5 increments between contracts, along with the fact that there's only monthlies. So the 55, the interesting thing here is that even with the stock's big move above the price that I sold, the asking price here is still only about 30 cents away from that. So it's a little under 50%. That's not hugely productive. And even though, so there is a lot of open interest here, which means that you could probably try to split the difference between the bid and the ask price here. If you wanted to try to roll this, there may be an opportunity to maybe set a buy to close. Let's do BTO, and that is not Bachman Turner Overdrive. Let's call it 45 cents. You could set that, and with 2,000 contracts in open interest, there's a fair chance that you might get that trade. It's not a given. It's certainly not a guarantee, but it is a possibility. So that's interesting. Of course, if you were bought out of that contract, it does beg the question of what you would do next. So the question at that point becomes, you've got $1 available here at 60 with the stock just a little bit above that point. Are you comfortable with that for the next 2 weeks? If you are, that could be interesting. Again, not a recommendation to buy or sell. With the next contract being the third week of December and a little over a month out, I probably wouldn't want to work with anything in this expiration period right now. Maybe in a few weeks, but This is one of the elements with these kinds of stocks where you're only working with monthly options, where it becomes a little bit, the logistics become a little bit more difficult to manage, and so the attractiveness of the active trade management is probably not quite as high as you would have with some others. So, if any of you have a different take on Eastman, if maybe you're working with different numbers than I am, feel free to share them. If you haven't, that's okay too. So, okay. Also have a covered call. Then this is CTRA. This is what Barry was talking about earlier. Now your covered call is going to be called out today at 25. I sold the 24.50, and I'm out until the third week of November, so I've still got a couple of weeks here to wait. So let's check in on this one, Barry. We're finally catching up to your comment, and this is gone a little bit parabolic, hasn't it? Following this earnings report, it's picked up a lot of momentum on the upside. So we're all the way up here at 2670 now. And so for you, getting called out here is a great result. The interesting and maybe a little bit ironic thing is that at this stage, with this amount of movement, brought in 50 cents, 57 cents for a 3-day trade, which is a fantastic result. So Barry, there's your second mark, man. That's awesome, right? 57 cents. I mean, you're talking about you're more than 2% for 3 days. If anybody doesn't like that, if that doesn't make sense, then let's go have a different conversation. That's pretty fantastic. So this is 2 weeks from expiration still, and I've got to expand my strike, my contract list to get the 24.50. The interesting thing is that with that movement, buying this back right now would mean, for me, $4.10. Yeah, when you made the trade, it was bouncing around in the $25 price range. Yeah. And I was assigned this stock right here at 24. So this current movement is also favorable, with my cover call at 24.50. I've just got a couple of weeks that I've got to wait. The reason I wanted to show this current, let me go here. The reason I wanted to show the current price on the 24.50 contract is, you might be tempted to say, well, why don't I buy this back and try to take advantage of this new surge in momentum, right? Well, to buy this back, I got to pay $4.10. I brought in 45 cents. Oops, that wasn't supposed to be. I brought in 45 cents. So I'd be eating about $3.50. I'd basically be eating just about, actually even more. I'd be eating about a dollar over the distance between that contract's strike price and the stock's current price. That would be fine if I thought that the stock was going to continue to push above here and start to test these 52-week highs. And I'm not saying that it couldn't. I'm just saying that I don't know that it will. The truth is that the kind of momentum we're seeing right now this is really hard to sustain. The fact it's gone on 1, 2, 3, 4, 5, 6 days already is pretty remarkable. And yes, it could continue. Look at, we have this movement here, right? So it could sustain for a little bit longer. But the truth is that the odds are much more likely that at some point, short-term traders are going to start to take profits. And when we do, we're going to see the stock start to trace back again. Now, again, that's not a bad thing for me. It's got $2 here between the stock's current price and the strike price I sold, and this is still about 50 cents above the strike price that I was assigned at. So that would still be a net nice result, but a lot of people might look at this and say, "Man, there's $2.50, there's $2 that you're missing in profits on this one." Yeah, you're right. You're right. I accept that actively and tacitly when I sell a covered call. Remember, you're always putting an immediate cap on whatever the capital gain is when you sell a covered call. And that means that sometimes you're going to miss gifts like this. Gift. Not GIF, GIFT. You're going to miss opportunities like this. You're going to miss these big moves sometimes. But that's the trade-off. I'd rather take, again, we talk about low-hanging fruit. I'd rather pick up the money that's in front of me over and over and over and over again than ignore it in the hope that I get one of these every so often. These are the exception. The simple covered calls and put sales that we work with are the rule. Those are the ones that are just pretty much always available in one form or another. So I hope that makes sense. Okay. Another one, and Barry, let me just touch on Skyworks here. And on BMY, this is another covered call that came up this week. But let me touch on Skyworks really quickly, and then we'll get to these. We'll get to your other comments. But Gib, you're exactly right. Remember, we're trading options, not stocks. We're working with options. We are generating income, and that is the purpose here. If along the way somehow you have an opportunity to take advantage of those big unexpected moves, that's wonderful. That's fantastic. But I love that comment. We're gonna stick with the method. We're gonna keep doing what we do because consistency is key. When you stick with consistency, you try not to break. When you try not to change up the method too much, then that's when it continues to work out for you. Okay, covered call for Skyworks. This is another really interesting one where increased implied volatility worked out pretty interesting in pretty interesting fashion for me here. I was assigned in the middle of October at 75, brought in a little under $2 on that put sale, and then just a few days later had an opportunity to sell a covered call at 77.50 and bring in a very outsized premium on this for 30 days of 4.53%. Now, again, this is still a couple of weeks to expiration, but these are the numbers to keep in mind. 75 was the assignment price, 77.50 is the covered call strike price. So let's take a look. And this one's fading back. Again, I was assigned at 75. So this is faded back in pretty rapid fashion. Is now a little bit above 68. It looks like it may be testing this support a little bit. We'll see if it holds. had this earnings report come up, and looks like the market is not responding so favorably to it. Okay. This looks pretty sharp and pretty severe. But one of the things that is worth keeping in mind here, this is where the premiums that I've been able to generate become useful. $1.80 and $3.40 here. That means that I've got a buffer of about $5.25 below the 75. Sorry, let me change. There we go. So my cost basis on this is actually at around 69.80. Now, again, the stock is still below that point, but that puts my cost basis is somewhere around here. So my assignment price is up here, but I've got my cost basis down around here. That, emotionally speaking, changes. It may not necessarily change the analysis of what the stock's momentum is doing right now, but it may change the decision-making process. Hopefully, it minimizes the emotional weight of seeing the stock drop back like this. In my case, it does make it easier to think about this potential, really how much of a loss I'm actually in on Skyworks in a little bit more rational terms. It does lower the effect of that punch quite a bit. So, okay. So we'll see where this one lands. It's still got a couple of weeks to expiration. It could continue to fall, certainly. We are seeing a little bit of a gap, and I mean it's down about $2 on the day here. So we'll see what happens in the days and weeks ahead on this one. But it is definitely picking up bearish momentum. Okay. All right, really quick, Barry. We're a little bit over time, but I do want to check in on Intel. He says his $41 call. Looks like that is going to expire as the stock has dropped back. It's kind of doing. It's not as significant or as severe as Skyworks, certainly, and we're seeing a little bit better consolidation right now around the stock's current price. But yeah, it is below the 41 that you sold. So unless we see a major big time reversal in the next few hours, right? But that's okay. You've also been writing this one for a little bit, so I think you're going to be all right on that. Walmart is the other one that you mentioned. 110 calls again. You're taking advantage of the top end of the range here to sell the 110 and seeing it drop back. It is picking up some momentum now. Yeah. You brought in $1.03 times 3 contracts last Friday. So, pretty good. If I remember on Walmart, you're also in at a much lower price as well. So I don't think you're in a difficult or painful position with either of these. Yeah, Walmart around 60. So yeah, you're doing okay. What he really wants is just for me to do this. There you go. All right. Thank you, everybody. Thank you, Barry, for sharing those. Appreciate that. As always, I really appreciate your participation today. I hope this has been useful for you as it always is for me. If you have questions between now and next week, don't hesitate to reach out. Discord, Substack, rebelincomesystem@gmail.com is my email address, so you can also reach me there. Look forward to visiting with you if you do need to reach out to me. Otherwise, We'll talk again next week. Hope you have a wonderful weekend, and we'll talk next time. Thanks, everybody. Yes, we do, Barry. It's going to be interesting to see. Texas Tech is going to be a very tough game. They're a very, very good team. It's going to be fun. So, all right. Thanks, everyone.